In this week's video, we'll review the latest charts, data, and scores to help us answer the question, are stocks overdue for a sharp correction? We'll be moving quickly, so feel free to use the pause button on your video player. Some of the topics and questions that we will be examining this week. What subtle shifts take place during a 50% crash in the stock market? Meaning, what should we look for? How do periods marked by strong long-term trends differ? In 2024, is big money shifting to a defensive posture? And then we'll take all of the information that we learned in the front half of the video and ask, how does the S&P 500, tech, semiconductor, small caps, the equal weight S&P 500, and France, how do they all look as of Friday, June 14th, 2024, relative to these periods and this period? Since markets operate in fractals, these concepts that we're about to cover apply to all time frames, from a 1-minute chart all the way out to quarterly or annual charts. Left side of your screen, chart of the S&P 500. This is calendar year 1970. It's a weekly chart. We've got the 30-week moving average in blue, the 40-week moving average in green, the 50-week in pink, and the 200-week in red here. Starting here in calendar year 1971, and we're going to walk forward all the way to 1974 to see what we can learn about 2024. The S&P 500 rallies from this low in 1971, but right off the bat, it's noteworthy that price came back into the moving average cluster 3 times in relatively close proximity to this low here. The look of the chart tells us the bulls are in control, but they don't have a high degree of bullish conviction. This is a relatively weak trend. We got a very short look at what a stronger trend looks like. In here, we've got white space between the moving averages. Compare and contrast this look here relative to this look up here. If we walk forward to the end of April 1973, this is a concerning development. If we look at price relative to the moving averages, this looks different than anything that we saw here in calendar year 1972. Price prints a new weekly lower low below the moving average cluster after multiple weeks of indecisiveness. All of that happening with relatively tight, look at the white space here compared to the white space over here on the left, and flattish moving averages, and in the context of a flattish 200-week moving average in red. If we move out to the summer of 1973, it looks even worse now. When we failed at the moving average cluster here, blue, the fastest moving average, was on top. Now blue, the fastest moving average, is on the bottom. This is starting to look like an intermediate term weekly trend that's rolling over potentially. This looks significantly different relative to this over here when good things were happening. Once again, price fails at the moving average cluster. The moving average cluster is now taking on a stronger trend look, similar to this look over here. The only thing is, it's a stronger bearish trend. So we have a flip from a bull trend to a bear trend. This looks significantly different relative to this flip over here. So this is the type of look where we're monitoring things much more closely. And if we push into April of 1974, once again, we have a weekly lower low here after multiple weeks of consolidation. And look at the context. You've got the moving averages, the intermediate term moving averages, the 30, 40, and 50-week moving average coming down and crossing that flattish 200-week in red. This over here on the right really doesn't look anything like this over here on the left. This is 1973 here, this is 1974, and you can see the inflation rate, year-over-year inflation rate, 1972, 3.4%, 1973, 8.7%, 1974, 12.3%. So we have a lot of visible deterioration, and we have a lot of deterioration in the measurable data as well. And from this highly concerning look, really bad things happened. The A to B move from this point A up here to this point B in the lower right-hand corner of your screen, an S&P 500 drawdown of approximately 50%. And when we had this concerning setup here, we can also add to that the price had basically gone nowhere between these points here in 1974 and these points back here in 1971. Could make an argument this is your left shoulder, this is your head, and this is a shallow, low conviction right shoulder, and then you break the neckline in here, and then after that, it's ugly. And a drawdown of this magnitude, approximately 50%, that's not something that you want to experience if you're approaching retirement or you're already retired. Or maybe more importantly, spent your entire life building wealth. Nobody wants to see $1 million account get cut to $500,000. Nobody wants to see a $5 million account get cut to $2.5 million. So we're trying to use data to help us discern between normal volatility within the context of a long-term bullish trend and psychologically damaging and hard to sleep at night volatility where you take a big hit in terms of your net worth. Since the objective here is to better understand what's happening in the markets on Friday, June 14th, 2024, in addition to looking at a week rollover period like the one we just covered, it's also helpful to understand visually and mathematically what an extremely strong bullish trend looks like. S&P 500 weekly chart, the exact same moving averages. It's noteworthy that from this look here in 1994, we go through 1995, 96, 97, 98, and 99. The entire time, the S&P 500's weekly chart never closes below an upward sloping 200-week moving average. That is an incredibly strong trend. Also noteworthy, look at the space the entire time, for the most part, between the 30, 40, and 50-week moving averages and the upward sloping 200-week moving average. This occurs within the context of a much more favorable inflation and interest rate environment, but it's still helpful to understand what a strong bullish trend looks like and understand how long strong trends can last. And as we all know, all good things must come to an end, and it was noteworthy here in 1999 and into the year 2000 that price dropped below on a weekly basis, weekly closing basis, below the 50-month moving average 4 times in a relatively short window. That's quite a bit different relative to anything that we had in here. In fact, we never got a weekly close below the 50-week moving average in 1995, 96, 97, and into the second half of 1998. So all of the concepts that we just talked about apply to this chart as well, including this rollover look in here that occurs in calendar year 2000. Look at the context of this move here in late 2000 relative to the context of this move here in calendar year 1998. This look was followed by higher highs. This look in here was followed by lower lows. So we want to understand what bend but don't break looks like relative to bullish trends. We also want to understand when the bend turns into a break. Because once again, the A to B move, very, very difficult to swallow relative to your net worth. Now let's take the concepts from this window and examine them in years that you might be more familiar with, 2015, 2016, 2017, as well as 2024. Exact same moving averages, 30, 40, 50 week, and the 200 week in red. If you know your stock market history, you know this bullish trend here in 2015 peaked in May on a daily chart and had kind of a double dip correction. So we've got a base in here where price moves sideways for a long period of time, 2015 into 2016. Then we break above that base, and eventually we become very extended. If we go from this point here out to this point here in early 2018, this is what extended from a base looks like. Yes, this is a strong looking trend. Yes, the 200-week moving average is sloping up. But we've been rallying for a very long period of time and are probably due for some type of break or sideways action. And in the real world, that's what happened. You drop about 10% from this look here, and then in Q4 of 2018, you almost have a bear market, drop approximately 19 to 20% in the S&P 500. But that happens when you're 19 months from a base. How does that compare to the present day? Mid-June 2024, we didn't break above this base here from late 2021, early 2022 until late 2023, early 2024, and thus we've only been above this base for 5 months. The look of this chart here is significantly different from the look of this chart here, telling us it's possible that we still have several months of rally ahead of us. Possible. That's not a prediction in any shape, form, or fashion. Another example that we just looked at, we're 5 months from this base here. We had a base here, lower left-hand corner of your screen, and the market rallied above that base. For the most part, rallied for several years before you had a significant pullback here in 1998. This breakout occurs in Q1 of 1995, and in 1995, 1996, 1997, and into the second half of 1998, you have a very strong trend with the weekly chart staying above an upward sloping 50-week moving average. And if we go back to the present day chart, we just had relatively recently in 2022 a transition from a bull to a bear, a significant bear market, and then relatively recently, May of 2023, we have the transition back that we've covered numerous times in these videos dating back to May of 2023. It's probably fair to say that this look here in 2023 looks a lot more like this favorable turn here where the market continued to rally for several months relative to this unfavorable turn here in 1973. Thus, if the present day chart started to morph into something that looks more like this, concerns would increase. But that's not the case. Put the present day chart over here with the same moving averages. This is the look on June 14th, 2024. This really doesn't look anything like this. And this really doesn't look anything like this up here, where we had multiple touches relative to this moving average cluster. In fact, the look on June 14th, 2024, if you're looking at things objectively, looks most like this window here in 1995, maybe into 1996, and maybe this window here in 1997. That doesn't predict anything. It just tells us that market participants in the present day do have strong bullish conviction. That doesn't mean we go up every day, and that doesn't mean we can't reverse. But it's factual to say there's nothing on this chart that tells us the longer-term trend is in jeopardy on June 14, 2024. That doesn't mean good things are going to happen in the next 3 days, 3 weeks, 3 months, or maybe even 2 years. But it does tell us the odds are favorable. No matter what happens, eventually this trend will go on and make higher highs, as it did several times this week. So we know what a strong trend looks like, and we know what a concerning rollover looks like, and we know what a bearish trend looks like. This is the look of XLK, the tech sector ETF, during the session on Friday, June 14th. When we had this pullback here in recent weeks, several weeks, the charts told us that for the most part this looked like normal weakness or a normal give back within the context of an existing bullish trend, and if that were true, that we would eventually go on to print a higher high. And that has happened on the weekly chart. So for the most part, everything that we said, including the base about the S&P 500, applies to the chart of XLK. Very difficult to say that this looks concerning relative to semiconductors, with one exception. This chart, in terms of these moving averages, is taking on somewhat of an extended look, so we have to have realistic expectations. We'll see how it unfolds. But once again, there's nothing here that says the long-term trend is in doubt. Based on what we have in front of us today, it says most likely SMH will be higher in a year, year and a half, 2 years, 3 years. What it does in between, we know with 100% certainty that it's going to have normal volatility, counter trend moves, and givebacks. If you prefer to look at an ETF chart, this is VU, the S&P 500 ETF, maintaining a strong trend look. And we're not forecasting anything here, but relative to the 30-week, the 40-week, and the 50-week, and the 200-week, keep in mind it's possible to maintain a favorable look for a very long period of time. We fully understand that this window from 1993 here to the year 2000 fundamentally is significantly different relative to 2024. That's not the point. A bullish trend is a bullish trend. They all look the same. The combination of the fundamentals is different in every environment. In this case, the net aggregate opinion of all market participants regarding all subjects on all time frames was favorable. The fundamentals in the present day are significantly different, but we can make those same statements in mid-June of 2024. As always, commentary is based on the chart in front of us. You can take the concepts that we've talked about in this week's video and apply them to the CAC 40 in France as well. So far, based on the chart that we have in front of us, this is as of the close on June 13th. All of this consolidation in here from 2023, all of this consolidation from 2022, all of it occurred within the context of a rising 200-week moving average. Now, even if the CAC 40 is going to go on and make a higher high, not a prediction, it's well within reason that it could come down into this area here, maybe retest this level here. This move here was followed by higher highs. But we still have a full-bore bullish look almost. 30-week moving average on top, 40-week, then the 50-week, and an upward sloping and relatively confident-looking 200-week moving average down here. So it's very difficult to categorize this today as nothing other than normal volatility within the context of an existing uptrend. The last thing that you did was make a higher high, a meaningful higher high. The last low, well above this prior low here from 2022. Concerns would increase significantly. If price moves into this area, that would be increase number one, and more so if we moved into this area here. We'll see how it unfolds. But the chart's telling us it's possible we could see additional downside and still remain in a bullish trend from a long-term perspective. If you look at the daily chart of the EWQ ETF, price is coming back to an upward sloping 250-day moving average in black. There's a lot of potential support in these areas here. So we'll learn something if price doesn't make a stand here, but keep in mind, you can get overshoots. When you overshoot here, notice the slope of the 250-day in black is up. Right now, that's what we have. If we drop below it like this in early 2022 and it starts to roll over and you come up and can't recapture the moving average cluster, very similar to the concepts that we covered when market was rolling over earlier in this video on a weekly chart, then concerns would increase. As always, we'll learn something either way. Here's one of your laggards, the equal weight S&P 500, still maintaining a full bore bullish look from a longer term perspective, and still holding above this base here that goes back to late 2021, early 2022. If we look at the anchored volume weighted average price chart, nothing particularly alarming on here yet. Concerns would increase if price dropped below this orange line here. The longer it stayed there, the more concerning it would become. But right now, we're still above the anchored volume weighted average price line on this chart tied to late 2023, so the year-to-date anchored volume weighted average price line. So far, this looks like normal consolidation. Look at the slopes of all of these anchored volume weighted average price lines. Most of them, the longer term ones, remain up. Again, a laggard. All of this consolidation occurring well above an upward sloping 250-day moving average in black and still holding the breakout above this level here from early 2022. So after a move like this is the October low here in 2023, this point A here to this point B, wouldn't be shocking within the context of an existing uptrend if price came all the way back down into this area here. Not a prediction in any shape, form, or fashion. If you break the box here, the black box, we learn something. If you move into this area here, we learn something. But this chart, too, doesn't really put the longer-term risk-reward profile of the market in serious jeopardy in its present form. We should keep in mind, remember the 2018 chart where we said we were extended from the base? Markets have a tendency to base, rally, and base. So at some point, SMH, XLK, ETFs that are market leaders, they've reestablished their leadership. XLK on Friday morning was up over 5% for the week. Same can be said for SMH, up 5.42% at 9:48 a.m. on Friday, June 14th. At some point, those ETFs are going to consolidate their gains with some sideways and downward movement. This is research from Ned Davis, Dow Industrials, 4-year presidential cycle. They're projecting forward from roughly the present day down here into 2025, 2026, and 2027. Historically, probably pretty fair to say this looks like an uptrend. Have to have realistic expectations about how markets operate in the real world. Givebacks are 100% normal and to be expected. Participation this week, not great. RSP, Friday morning, 9:49 a.m., the weekly chart, down 0.5% for the week. So that is noteworthy in the short run. But still, there's no significant damage to this weekly trend at this point. Now go back and look at the transition or pivot points in the other videos. There's the bearish pivot here in 2022 for IWM small caps. It's very, very difficult to say anything other than that this looks like an attempt at a bullish pivot. 9:48 a.m. on June 14th, blue, the fastest moving averages on top, red, the slowest moving averages on the bottom. Now, having said that, this is a pay attention tight look in here, but if we maintain this bullish bias with price above this consolidation or base area back here, and with the moving averages turning up, this tells us it's possible we could see a big move to the upside. Now that would change if price moves into this area here, and that may happen very, very soon. It just hasn't happened yet. It's also noteworthy. I've been talking about this for a long time. All of this consolidation for IWM relative to the anchored volume weighted average price lines, for the most part, maintaining a healthy look with a bullish bias. That too would change if you move into the cluster, and it would change significantly if you move into this area here. And again, all of that may happen, but right now this looks like relatively healthy consolidation after a constructive breakout in Q4 of 2023. Given what we know today, concept that we covered with this slide in the March 1st video still applies. A lot of our positions have gone on to make higher highs after some givebacks. All of this still applies. 3 to 6% pullbacks, not particularly abnormal. Even a 3 to 14% pullback in this environment, not particularly abnormal. We're not making any assumptions about what happens, and we're not extrapolating the charts that we're covering today. If the charts begin to shift, we have to reassess. Exact same concepts that we covered when things were weaker for tech and growth in March of this year. March 8th, we also mentioned that counter trend moves are 100% normal and to be expected, regardless of how strong the primary trend looks. And we're going to see leadership counter trends. So earlier this year, XLK flipped from a leader to an underperformer, and now it's back to a leader. IWM has never flipped to a relative leadership position despite a still constructive and hopeful setup on these charts. And that's reflected in the weights in our portfolios. Look how much of IWM we own relative to other positions. Concepts from March 29th. We want to make sure in this environment that we don't get too cute. When in doubt, within the context of a long-term uptrend, stay with the trend. We're longer-term investors. Long-term goals require long-term thinking. And if we're going to think long-term, we have to have realistic expectations about normal volatility. We haven't had evidence year-to-date of any significant leadership flip. IWM relative to VU on a daily chart with the 20-day all the way out to the 250-day really hasn't done anything to flip the relative trend. Concept from April 26th. Bull markets eventually make higher highs. Something that we talked about in early May. These charts were covered on May 3rd. This is a slide from the May 3rd video. The concepts, in terms of all this consolidation and volatility occurring within the context of an uptrend, those concepts for now still apply. These are charts that we covered in mid-May. On a relative basis, Tech XLK divided by SPY, this looked like a normal counter trend move within the context of an existing uptrend. In mid-May, this chart said try to be patient with tech. If we fast forward to the present day, after the close on June 14th, this exact same chart has gone on to print a higher weekly high. It looks like it's trying to reestablish the leadership trend. Is it possible this is a false breakout? Absolutely, positively, yes. But right now, the chart looks healthy. All of this occurring above an upward sloping 200-week moving average in red. This is XLK relative to SPY. The chart that we covered in mid-May, XLK relative to SPY. We're not making any assumptions about what any of these charts look like in the coming days, weeks, months, or even years. Day by day, maximum flexibility. Similar situation, semiconductors relative to the S&P 500 SMH divided by SPY mid-May. Covered this chart in the May 17th video. The ratio was still above this very long-term base from back here, and all of this was occurring above an upward sloping 200-week moving average in red. And on May 14th, despite this recent relative weakness in here in 2024, this is several weeks, all of this was occurring above an upward sloping 30-week, 40-week, 50-week, and 200-week in red. Mid-May, we use this chart to say it doesn't look like we're getting a leadership shift from large cap to small cap or away from tech. How about increasing market fears? Some money managers have to stay invested. So when they're concerned about the economy and future stock market outcomes, a lot of them run into consumer staples, XLP, conservative stocks, toothpaste and toilet paper. This is a defensive ratio. We covered this in mid-May. This is what increasing fear looks like during the bear market. This is what the chart looked like on May 14th. On May 14th, this looked like a counter trend move within the context of a downtrend against defensive XLP and favoring SPY. How does the exact same chart look today? Better, worse, or about the same? If you're a stock market bull, it's very, very difficult to argue for any other answer other than better. We just made a new 52-week low. The ratio came up to a downward sloping 30-week in blue, was rejected, and undercut this low here in April. If this look over here, and this looks like a strong downtrend look, compare this to the bullish look in 1995 and in 1997. This is a strong downtrend look. It's a strong risk-on look. If this starts to morph into something like this, then concerns would increase. This chart dated June 14th at 3:25 p.m. Eastern Time. Last week, model scores said try to be patient. No significant shift on June 14th. Given what we know today, and given how markets operate in the real world, the data that we have in front of us, the charts that we have in front of us, are allowing us to think longer term. If the charts and the data begin to shift, we have to be willing to reassess the probabilities. And we all know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.